Morning. Welcome to the Compliance and Freight Policy Council at the OTA Council Summit Day. For those of you who don't know me, my name is Jeff Wood, Vice President Operations and Safety with OTA. This council, the newly renamed Compliance and Freight Policy Council, is an extension of the former OTA Safety Council. So the purpose of today is to do a number of things. One, allow you folks to network with industry peers. Two, get a little bit of education. Three, have some fun. And four, have fun. So we actually have a fairly busy schedule today, and we're going to have a series of 5 presentations. Before we get started with that, I do need to do a little bit of council business, and just for everyone's information, this is actually the second meeting of the Compliance and Freight Policy Council once we reinstituted it in March. So it's a little bit of a bigger audience. The first meeting we had in March, there were 17 people, and I think here we have close to 100 or more. So the goal going forward will be to add you to a contact list, and we will start the communications that way. A little bit more detail about the role of this committee. It will start to take on a more formal role in the policy development side of things that will eventually feed into OTA board policy, which will direct our lobby efforts going forward. And obviously the second intention of this is to allow networking. So I see lots of familiar faces. Want to welcome you, and we're looking forward to working with you. So there's a couple things that we're going to do. Obviously, I've introduced myself. We're not going to do introductions because we'll be here all day, and we're on a tight schedule. In terms of attendance, if you haven't signed the list, we'll pass it around. Please get your name on it, and then we'll get all your contact information, and we can communicate going forward. Review the agenda. So, like I said, we've got 5 topics. I think you've all had a chance to review the agenda. So we're going to start with some broker carrier discussions. We're going to get into a little bit of work on litigation and U.S. collisions. After lunch, we're going to get technical with some ELD information, where we're going in the States and Canada, followed by SPIF, explained. A gentleman from the ministry is going to come and have a chat with us. And then the last session of the day will be some discussions on mandatory entry-level training. So that's what we're doing. Like I said, we're on a tight time schedule. Hopefully, you can stick around for lunch. Lunch will be served in the room next door from 12 till about 1:15. Again, the format of this session is very fluid. So if there's something here you want to see, and then in the next, there's another council that's operating concurrently. If you want to go. By all means, don't feel obligated to stay here all day. And just a couple of housekeeping items. If you do have your phones, if you can turn them off, and just be respectful. If you're leaving this session and going into another one, the times may not line up exactly, so they may be mid-presentation. In terms of, let me flip council chair nomination process first before we get into Robert's Rules and the Canadian Competition Act. So at our previous meeting, we had asked if there were individuals who were interested in running for the chair and vice chair positions of this council. Again, I had mentioned it's going to take a more formal process going forward. So we had 2 folks that had indicated an interest. So I'm pleased to announce that Joe Ball from Myers Transport, Peterborough, Ontario, will be our sitting chair for the next 2 years. Joe is unable to be here this morning. He's tied up in another presentation, but Natalie Myers is here from the company. So we're glad to have Joe on board. And Joe was our past chairman of the Safety Council, so some institutional knowledge coming forward again. The vice chair will be Anissa Copeland from the Transforce Group of Companies, and she's based in Cambridge. So Anissa is in the front row, so why don't you give everybody a wave? I think a number of you probably know her, so we're glad to have both of them on board. Anissa will be our vice chair, and her role will transfer into the chair role in 2 years. So with that, we'll do 2 more formalities. Robert's Rules of Order. Basically, that's code for if you want to ask a question, just put up your hand and we'll ask instead of doing what I do, which is blurt out all the time. And then the Canadian Competition Act. These meetings have to be governed under the Competition Act. So I'm going to ask Anissa to just stand up and indicate that she's reviewed the agenda and that it's in compliance with the Competition Act. Perfect, thank you. Okay, so with that, I'm going to turn it over to Mike McCarron, who's going to moderate our first session.
Thank you very much, Jeff. I'm a little disappointed we can't talk about rates, but I quit.
That's one of the things in the Competition Act. That's really the only thing.
No rates. Anyway, so thank you very much, ladies and gentlemen. And thank you, Jeff. As Jeff mentioned, my name is Mike McCarron. I'm president of Left Lane and Associates. And I'm honored to be moderating this session. Before we start the session, I just want to send some kudos to the Ontario Trucking Association. I think this is an unbelievable format to see 300 people that care enough to be here, to learn, to network. It's really spectacular. I'm used to events like the OTA convention, which is largely senior staff, and it's really nice to see such enthusiastic faces. So good on you for caring enough to come. Hopefully you're all members of the association, and if you're not a member, then maybe this is some good ammunition to join. Today's topic is one that's very interesting to me, and it's certainly one that I think is very concerning to carriers and brokers. Just to put in perspective how much this has changed. In my previous life, I was the president and owner of MSM Transportation, which was a hybrid transportation company which was a combination of freight brokerage and trucking. So we accompanied both disciplines, and we moved about 120,000 shipments a year, and we had about 500 active customers. I sold the business in February of 2012, so October 2012, and so about 3 years ago. How many customers or brokers do you think that we had on contract when I sold that business just a little over 3 years ago? Zero. Not one. When we went through due diligence, we did not one contract with customers. Not to say at that time that customers weren't starting to begin the process, but we didn't have one contract. Today, when I did the research, and thanks to Matt from Marsh, who I'll properly introduce in a second, when I did the research, I was staggered how much things have changed. In fact, when Matt was doing a lot of legwork on this, and he prepared a really interesting PowerPoint presentation, I phoned Matt yesterday and I said, Matt, I can't understand this. This is absolutely confusing the hell out of me because insurance was really not my bag. So, the complexity of this is staggering. And when I read some of the implications of this, it made me really happy I sold my business. Because it just is another level of customer complexity that to deal with. So just to give you a sense of the format, Matt from Marsh Canada is going to run through a presentation that he has taken from PhD level to master's or BA level, so we can understand that. And then when he is completed, we're going to go through a panel discussion with the four industry experts up here. And what they're going to bring to the table is really some practical expertise and experience based on what they're seeing. And so, without further ado, I'm going to have them self-introduce themselves, starting at my far right with Marsha Robitaille.
My name is Marsha Robitaille. I'm the Executive Vice President of Operations at Traffic Tech. I take care of North America, so the Canadian and U.S. offices. I've been with Traffic Tech for 14 years. I'm on the board of directors for the Montreal Traffic Club. I think like most people who have the word operations in their title, it means wearing a lot of hats. I'm on the council that the claims department reports to. I work hand in hand with our director of safety and compliance. And I think that this is a super interesting subject. One of those people who is actually interested in insurance and liability.
Yeah, because I'm sure not.
I've seen my fair share of broker-customer contracts. I've negotiated them. I've worked with insurance companies to make sure that my company is covered for the liabilities we accept, and I've also seen Traffic Tech's carrier broker contract change a lot over the 14 years I've been there. So I'm very happy to be here today.
Thanks, Marsha. Thanks for coming, and congratulations. The Montreal Traffic Club has the best social event in Canada, which is our lobster night. It's spectacular. Next, David Caruth, CEO of One for Freight.
Good morning, David Caruth. Thanks for joining us today with One for Freight currently. Been in the industry, or Ontario, New England, One for Freight. Been in the industry for 32 years now through various operating and entrepreneurial roles. Currently, I'm a member of the OTA Board of Directors as well as the chair of the OTA's lead committee for leadership through education and development for our next generation folks. We are a very hybrid business, a true intermodal business where our clients touch all of our conveyances, whether it's our own fleet, whether it's Class 1 rail, whether it's brokerage operations that we share with our carrier partners. We look at our relationships with load brokers a little differently. We classify them either as freight partners or pure load brokers. This subject is very interesting for us because there is a number of contracts that get sent through both internally for us with our carriers that we use, and then from brokers or carrier partners that send us contracts. I would say about 20% of the contracts we see people are educated to talk about, and about 80% of the contracts we get sent in, they've been taken off the internet or ripped off from another company and just sent in for a carrier to sign, and they don't know, the broker does not know what they're getting signed. So, a very interesting topic.
Thank you, David. And I know this is a very difficult day for David because he's missing his men's day at the Hamilton Golf and Country Club. So, thank you very much for coming. Beside David, Luca Torreson.
Luca Torreson from Effective Logistical Solutions, also independent contract for Houston Logistics Americas. We represent Houston on the over-the-road and intermodal side. We were the founding office for Houston in Canada to look after that. So I helped put together with Catherine Pollock, who's a lawyer downtown at Gowlings, our carrier broker agreement. I've seen many of them. I've been in the industry 23 years working for two major brokers in the country. And this topic's very interesting to me because I've been on both sides of the spectrum. We've got customer contracts coming in, and at the same time we've got the carrier contracts. And the bigger carriers are refusing to sign certain contracts based on different avenues altogether. But at the end of it, these contracts, sometimes we end up seeing the contract way before we've submitted rates. So it's very interesting that you get the contract after the fact, after you've negotiated the pricing. So right now, I think currently Houston has 1,300 Canadian carriers in our database, and about 7,000 in the U.S.
Wow.
So we've got two separate contracts. One's a Canadian for the Canadian side, and one's for the U.S. side.
Great. Thanks, Luca. Just to clarify one point that's come up a couple of times, you might have heard the term hybrid, which is, just to be clear, I'm sure you've heard that before. That's kind of a new breed of transportation companies that really have evolved the last 5 years, which combine assets, the trucking side, and freight brokerage. And the thought is when trucking business is slow and rates are depressed, it might hurt your trucking business, but you kind of make it back on the other side. So when you hear that term, that's what it refers to. Beside Luca, my pal Mark Bilesma.
Thanks, Mike. I'm Mark Bilesma, president of Spring Creek Carriers, and now that Mike's just explained it, I guess I have a new brand. We're a hybrid carrier. Spring Creek Carriers and Spring Creek Logistics, and it's probably 80-20, where 80% of our business is asset-based and 20% is brokerage-based. We've been in business. We're celebrating our 20th year. Probably 15 years of which we've been members of the OTA, and for many, many years, sitting in councils like this and seminars like this has given us a great deal of knowledge, and also being able to give back. I hope this is valuable for everybody here. I think it's important that we as peers, I know we compete from Monday to Friday, but we also that we get together and share ideas to make the industry better. So I sit on the executive of the OTA and also on the board of the CTA. I'm probably, to speak about these contracts, we align ourselves on our brokerage side much more with partner carriers, people who we know and we've respected for 20 years. We have a very thorough filtering process before we allow a new carrier to haul freight for us. I wouldn't say we're real diligent on the contract side of things, but they have to meet all of our criteria. And we seldom go outside of our small group of partner carriers. And that's really how we protect ourselves. It's not that we haven't been burned, but you can also get burned with the contract. So that's kind of how we operate right now. After today, I might be knocking off Houston's contract.
Done yet? Thank you, Mark. And Mark, you know, sometimes it takes these hip terms to take a while to move from Toronto to Beamsville. So at some point in time, hybrid will be making an appearance in Beamsville. Next, and I'm going to pass the podium over so he can introduce himself. Matt Yeshin, the Managing Director of Marsh Canada, and I want to thank him for all the tremendous, I know he educated me a lot on the subject because it really was something new to me, and I want to thank in advance, Matt, for all the great work you've done. So please welcome Matt. Yeshin is going to have the mic for the next 10, 15 minutes. Thank you.
All right. I guess I'll stand up then. So, yes, I'm the insurance guy on the panel. So I'm Matthew Yeshin. I'm with Marsh Canada. I head up the marine logistics and transportation practice for Marsh. I started out my career, I've been in insurance, I've actually been with Marsh for almost 25 years. So I've done a lot of time in insurance. And I started out in the marine department as a cargo guy. So I was putting together insurance programs for our shipper clients. So these are the guys that are moving commodities. And I've seen a lot of the agreements that our shippers were looking to put in place to protect their cargo programs. Then as I moved into the logistics side of things, I started to see some of the contracts that I was putting together for my shipper customers showing up with some of my logistics clients, which I thought was kind of interesting because I knew the liabilities that our shippers were trying to cascade down to the logistics companies. And from there, I got into the transportation side, and now I get to see some of those contracts as they've cascaded down to the carriers. And then they get cascaded further down to some of the subs. So it's actually been pretty incredible to see how this concept of contracts and contract liabilities has moved through as a risk management solution from shipper to broker to carrier. And that's what I'm going to talk about sort of as get into the presentation. So if it's okay, I'm going to move straight into the, I guess you can call it the technical side of the presentation. And this is really getting into why contracts are potentially a problem. And I'm looking at this from an insurance perspective. There's no lawyers on the panel, so I'm looking at it from a risk perspective. There's plenty of other reasons why contracts could be problematic, and there's plenty of reasons why we've seen an uplift in the number of transportation lawyers over the past 5 years as these contracts become more prevalent. But my focus is on the insurance, or the risk side of it. So looking back, I mean, traditionally, it's the bill of lading that's or a standard set of trading terms that governed transportation. Liability under a bill of lading, it's limited, it's consistent or relatively consistent, and it's reasonably well understood both by the parties to the contract as well as by the courts. And you'll see in international transportation with marine carriers, the bill of lading still is the primary contract. None of the shipping lines are changing their bill of lading terms or agreeing to contracts yet. There's a few brokers out there who are trying to get the shipping lines to change their terms. But for the most part, international transit is done on a standard set of terms. It's much more the domestic side, inland transit and transportation companies, and particularly land carriers, that are agreeing to change their terms of trade to accommodate the shipper's requirements. And I'm trying to get an understanding of why this is taking place. And we always point back to the Home Depots or the Walmarts, who are the big shippers basically cascading liability down the chain. They see it as a risk management solution. So a Home Depot is going to take or put together a cargo insurance program. They're going to take a very high retention, and they're going to say to their broker or to the carrier, all right, I've got a pretty high cargo insurance retention. I don't want to have to pay for any of my claims, so I'm going to make you responsible. And what's been happening is that somebody's been signing that agreement. They've been saying, okay, well, I want your business because you're Home Depot, because you're Walmart, you have a huge volume. So yeah, I'll take on that liability. I'll take on the first $100,000 or $200,000 or $500,000 of cargo loss, and I'll do it on an all-risk basis rather than a limited liability basis, because you're a big shipper. The problem is that that Home Depot contract started getting cascaded down to smaller shippers, and even smaller shippers. Now everybody has a contract, and they have a contract that they want to be signed. And those contracts are not necessarily good contracts. And I'm going to go through a little bit of why those contracts might not be good contracts. So basically, I want to get into a little bit of some of the onerous issues that we're seeing in these agreements. I've cascaded through my notes a little bit faster than I'd intended to. So what we're seeing is these contract agreements are extreme and not aligned to the value of the work being provided. If you've got a load, it's maybe generating $500 or $1,000 worth of revenue, or even just freight, and you've got a contract liability for $500,000, it doesn't really seem very well aligned. If you lose that load, you're liable for $500,000 or $1 million, yet you're only making $500 to move that load. It doesn't seem quite right. But this is what these contract agreements are doing. Also, there's no real validation taking place as to whether those contractual requirements are being met. So these shippers or brokers, and I'm going to focus more on the shipper side of it because that's really where the issues are starting. These shippers are putting these contractual requirements in place, saying you've got to sign this agreement, you've got to provide us with some evidence of the cover that you've got in place, but there's no one really checking that that coverage is really in place. Until, of course, a loss happens, the shipper pulls out the contract and says, hey, look, we've got this agreement, you're now liable for this. And of course, to sort it out, you've got to get a lawyer involved because nobody understands the terms of that agreement, nobody understands what was in place, and of course, nobody put any insurance in place to backstop that agreement. So what do they do instead? We see a lot of companies providing certificates of insurance as evidence that they've got the coverage to meet the contractual requirements, but no one's ever really validated that. And one of the biggest issues I have from the brokerage side, because I know the shippers, I know the carriers, and I know the brokers, we get these certificate of insurance requests. So there's a contract somewhere floating around out there. They got a load, load's about to leave. It's maybe 5 to 5 on Friday. There's a load about to go. There's a contract in place. We need a certificate of insurance, evidencing cover, and we need to name all the parties, and we need to ensure that the contract terms are agreed by underwriters. The certificate must be issued right away or the load doesn't leave. So our position on this, which isn't well received by a lot of carriers, is that, okay, well, let's take a look at the contract, let's assess the liabilities under this agreement, and let's decide whether or not it's the right thing to do from a risk perspective. But of course, at 5 to 5, that's not going to get the load moving quick enough. So we see a lot of issues about that. But what does happen is potentially people are just issuing a certificate of insurance. They're passing that certificate of insurance over and saying, okay, yep, I got the cover, don't worry. Here's the certificate of insurance that proves it. That certificate of insurance could be meaningless. There's no protection on it anymore. And we had an interesting one with a certificate of insurance that was issued by a carrier, by a insurance broker of the carrier. The certificate of insurance looked pretty good. It's cargo liability. They had the necessary cargo liability, or it appeared to, the necessary limit, no deductible issues. All right, certificate of insurance says this carrier looks okay. The load was released, and the load, of course, got into an incident. There was an accident involving the load. The cargo was lost. So the shipper wanted to go back against the carrier to recover. And of course, they'd done all the right things, so they added the shipper as a named insured, or theoretically as a named insured under the cargo liability policy, so that that shipper could go directly to the insurance company, in theory, to get recovery on that. The insurance company came back and said, no, we don't provide coverage for that product. Our cargo liability policy only covers 2 commodities. And it covers only 2 commodities. This is a cargo liability policy. This is a general carrier. No, their cargo insurance was so specific that it only covered 2 commodities. And of course, the load that they were hauling wasn't one of those 2 commodities. So while there was a certificate of insurance in place evidencing that the coverage was there, it actually had no value at all. So, in terms of contract liability, there are a lot of issues in a contract that can be problematic. And I've got a bigger presentation, as Mike mentioned, that I've carved down quite a bit, just to focus on some of the bigger issues that we're seeing, and I guess to discuss a little bit about why those are a problem. One of my favorite ones is the increased valuation. So, the traditional $2 a pound or Carmack limitation in the US is just not cutting it. So every shipper, every broker would like to see the carrier liable for full value, retail value, wholesale value, some specific and often undisclosed value of the goods at the time the contract is being signed. Sounds all right, on average they're shipping about $50,000 of value per load. Yeah, sure, I'll sign a unlimited or no or increased value contract. How big's the risk? And I'll talk about how big the risk could be in a second. The full indemnity provision. Full indemnity provisions are another huge issue. And this isn't really even in the insurance section. It seems like a pretty innocuous clause. It's, you'll indemnify us, we'll indemnify you. Well, actually, the cascading effect of a full indemnity clause is that you could be picking up the legal costs as carrier of not just yourself, but of the broker and of the shipper. In the event that your truck or your load gets into an accident, you will be picking up three parties' legal costs, in addition to potentially the liability or contingent liability of everybody in the chain. It's a huge, huge risk. Penalties, liquidated, special and consequential damages. Of course, these are slipping in more and more often as shippers want to make sure that the carriers are on the hook for any penalties assessed. So you miss the window at Walmart, $500. You miss it again, $500. You got 10 shipments in there a day, now you're $5,000, right? So this is your responsibility. This is what they want to see cascaded down to the carriers. And insurance isn't necessarily going to pick that up. And of course, then my other favorite one is the insurance extension clauses and the loss payee or additional insurer clause. So, and I'm going to just talk a moment on this one. A cargo liability policy, a motor truck carrier's cargo legal liability policy, is a legal liability policy. Adding a shipper to that policy does not give them any rights to make a claim against that policy. As a carrier, to trigger coverage under a motor truck cargo legal liability policy, you have to be legally liable for it. If you're not legally liable, no matter how much the shipper yells and screams at the insurance company, they're not going to pay the claim. Yet everyone wants to be added as an additional insurer to that policy. It doesn't make any sense. You're not actually extending rights to that shipper. You still have to be legally liable for it. And one of the biggest challenges we have in issuing certificates is trying to get an understanding of why the shipper wants to be added to a policy that they can't make a claim directly against. But one of the clauses that always comes up in these shipper agreements. Some of the other clauses that we're not going to get into as much, the offset freight clauses, direct routing clauses, so requirements that a specific route be followed, no cross-docking, and if it's cross-docked, then you're instantly liable for full value, even if nothing happened. No salvage or mitigation, another favorite one, so load shows up at Costco. Costco doesn't like the look of the grapes. They don't accept them, they reject them. So what's the trucker going to do? We can't salvage these things. You can't do anything with them because there's no salvage clause under the contract. So he's got to eat a total loss of cargo. Yet his insurance is only going to pay him for the value of the goods at the time of the loss or the portion of the goods that might have been damaged. So he's not going to get a full recovery against his insurance, but he's got stuck with a load that he can't do anything with. Even more so if it's branded product and he can't do anything at all with it. Then he's also got to pick up the cost of warehousing it and eventually destroying it, which isn't necessarily covered by insurance either. And of course, no subrogation. So just to highlight really quickly why it's an insurance problem. So you think you've got insurance for these contractual exposures that you're getting into. This is a standard cargo legal liability policy form. There's a lot of words in there. It looks pretty nice. You got coverage for physical loss, destruction, or damage to lawful goods, blah, 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 blah. Care, custody, and control on vehicles. Yeah, it looks great. But the coverage only applies where the obligations have not exceeded the limits or exemptions or standard limits or exemptions of liability. That means all it covers is your bill of lading. So if you're operating under a contract that's broader than your standard bill of lading, broader than your standard terms, there's no coverage for that. Not necessarily well understood. Another form, which actually looks a little bit better. I like this one because, of course, right on the front page, insurer will indemnify the insured for his legal and or contractual liability. Fantastic. Not just legal liability, not just bill of lading terms, but I've also got contractual liability cover. Well, you go through the policy, scroll down, 4 pages in, Part 24, subsection Q. Any increased liability in respect of carriage of cargo on a contract not approved by the insurer is excluded. So if you sign that contract on a Friday afternoon to move the load and you didn't get it approved by the underwriters, you've got no coverage for that liability that you've taken on. So, it's a bit of a concern. It looks like you might have the coverage, but you don't. And what can it mean? How bad could it possibly be? I've just signed, $50,000 load, no big deal. Just, no limitation on liability. So the XL versus Southern Refrigerated Transport, it was a case last year, and it's actually one of my preferred cases, preferred decisions. It's my preferred decision because in this case, the courts were actually right in their interpretation of the contract, and the carrier was furious about the results. So the carrier, Southern Refrigerated Transport, had signed a contract with the broker XL. And it was a reasonable, or appeared to be a reasonable contract, except there was no limitation of liability on the value of the goods. It was for the, retail value of the goods. No big deal, right? So it's just a truckload of goods, how bad could it be? Well, anyway, they picked up a lot of pharmaceuticals, and the pharmaceuticals were worth $6 million. So that $6 million load was stolen, and XL came back to the carrier and said, hey, you know what? You owe us $6 million. Well, you think Southern Refrigerated had $6 million of insurance? You think they told anybody, their insurance company, about this contract that they'd signed? No. So they went back and said, well, no. Carmack, $100,000, here's your check, thank you very much. XL said, no way, we're going to court. So Southern Refrigerated put forward their case, Carmack applies, $100,000 limitation. The courts read the contract? No, $6 million assessed against them. So Southern Refrigerated probably isn't in business anymore because that's a pretty hefty assessment for a small organization. But what they did is they signed a contract that had no limitation of liability in the value of the goods. They probably were only carrying $50,000 to $100,000 worth of goods most of the time, except for that one pharmaceutical load that they picked up that happened to be the one that got stolen. Anyway, so that's getting into why contracts are a potential issue, why they're a concern, and why they can't be insured goes back to that $6 million case. Every time you sign an agreement, you could be exposing yourself or your insurance company to a significant amount of liability. One thing insurance companies hate is being exposed to liability that they can't quantify or are not aware of. So what we've been seeing is, well, hey, why can't we just review all the contracts? Well, I'm reviewing a contract a day, and there's no way we can handle the volume of contracts that are going on, because any large broker who deals with a lot of shippers, any carrier who deals with a lot of brokers or a lot of shippers is going to be seeing an increased frequency of contracts that basically creates a significant problem for the insurance industry. There was actually one insurance company, which I think was fantastic. They offered a full legal and or contractual liability cover, unlimited, right? It was fantastic. We can't review all these things. We'll just let you, the carriers, the brokers, you can manage it yourselves, right? No problem. In 6 months, they retracted that cover. They had so many claims in 6 months, they could never make money. The control of the contracts and the risks under these contracts are so significant that it's almost impossible to insure. It's a review process. Anyway, that's my reason why contracts are potentially bad. And what I wanted to do now is just hand it over to the panel to go through some of the issues.
That's great, Matt. Thank you very much. Jeff, can the participants, attendees, get a copy of this PowerPoint? Yes. Just email sent to them? How do they go about doing that?
We will push it out to the registration.
Awesome, that's great. Matt, that was spectacular, and you gave me more reason to justify why I sold my business. Thank you. That's unbelievable. So I'd like to start things off with the panel once again. The discussion's really about some practical advice, how they're handling this. I'm going to start out with Mark Balsman. Mark, and every question I'm going to open up to the panel, so please jump in as you see fit. But I'm going to start with Mark. Mark, how have you seen this trend change the last 5 years with customers and brokers and this whole move towards contracts?
I've seen the, thanks, Mike. I've seen the third-party load brokerage world really, we've seen them amping up their requirement for contracts to be signed. I think we're pushing back a lot more. I think a lot of people are just signing them blindly. We're actually going through them, amending them, scratching them out, and losing business because of it from time to time. Other times, I think the recipient of that amended contract may just file it because all they cared was somebody signed it and put it away, and we've amended it to our liking. And then there are other people who say, yeah, no, we're not going to give you the load, and well, that's their prerogative. But we're walking away from business because of it, a lot more in the last few years. I'd say on the direct business side, the most unusual thing we're seeing there is if there are, I don't think the contracts are as prevalent, but we're also not dealing with some of the larger shippers in North America, some of the smaller ones. But one of the contracts we have with a very large shipper who's got exposure all over the world and lawyers all over the world is the contract had a lot of old language in it, especially when it came to the insurance side. So we gave it to our insurance company to review it, and they came back and said, well, the words they're using to explain the insurance, that insurance doesn't even exist anymore. I think what they meant is this. So they may be taking a 10-year-old contract and just changing the names or changing the dates or the terms and sending that out. Now, this one in particular is working with us to amend it, but there's probably at least 12 other carriers that provide services, and I think most of or all of them are OTA members. And others of us out there are just signing these things blindly. And so the shipper's looking at me and saying, Mark, why are you being such a stickler? Everybody else signed it, but we're going through and trying to educate them. And they're being reasonable. They're saying, okay, what kind of amendments can we make to make this actually legally binding so we're actually talking about the same insurance?
Do you think your competitors are actually signing this blind?
Yes.
Let's talk to, by the way, I know him as Chopper, so I can't call him David. Chop, talk about that for a second.
Yeah, I think, to echo Mark's point, in a comment I made earlier where brokers don't necessarily understand what they're asking to sign, I think 80% of our carriers don't necessarily understand what they are signing. And I know Mark and I talk quite a bit back and forth about contracts that are out there. We have some partners that we use together. We do a lot of freight back and forth together. So we're looking at the same agreements, and we're getting the same answers from some of the brokers that we've used of saying, well, XYZ carrier or Joe's carrier or somebody else signed this without sending anything back. And we're getting to the point where we see this, that not only is the broker not know what they're sending to the carrier doesn't understand what they're signing, and it's creating problems for the people that are really interested in hauling freight properly, being properly correct, being properly protected, as well as not putting the future of their business at risk, right? So to the point that nobody knows what they're doing right now.
So Marsh, Traffic Tech being arguably the biggest and leading broker in the country, when we were speaking earlier, you talked about your philosophy on contracts. What led to when did that change happen? What led to that change, and what implications has that had on your business?
Well, I mean, our carrier contract when I started at Traffic Tech was possibly 20 pages long. 30.
30 pages.
Maybe not.
That means it was about 80 pages.
And it's definitely reduced now. I think we have a legal department. We're members of the TLA. They're trained in transportation law. We will negotiate amendments with carriers, but I think there's a lot of small brokers that do just pull those contracts off the internet. Don't necessarily know what they're sending, and then there's a lot of carriers who don't take the time to go through them. And I think there is a bit of a trend with online onboarding, if you're, going to a website to onboard with a carrier, or with a broker, sorry, that you're kind of going through, entering all your information, uploading your certificate, and hitting I accept. And I think that's, in the last few years, probably one of the biggest changes.
So let me ask you this. When you're presented with a contract from a large customer and the shoe's kind of on the other foot, how do you deal with that when it's their contract?
It's not even large shippers anymore. I think that it's even small shippers that are asking us to sign all kinds of liability. For us, that we do not have specific contracts for our carriers that assume the liability that we've just taken from the shipper. What we do is we go out and we negotiate a shipper's interest policy to protect ourselves and the carrier, so that the carrier is still just liable for whatever their limit of liability is.
So Luca, do you think this is the new reality? Do you think this is just the horses out of the barn and this is going to continue forever?
We've seen it. Well, it's one of the reasons why when we started our brokerage company with my partner 13 years ago, we partnered with Houston Logistics, is because we saw all this coming. Instead of us trying to be a small broker and trying to navigate through all the legal stuff, and there's a lot of costs, and especially involved in that. So we got Houston involved and represented them. They've got a big enough legal department, a carrier relations group down there to look after all these contracts for us. I asked yesterday, our legal department, they've got 23 contracts on the table right now that they're trying to review. And that's just this month. That's just customer contracts with the thing. And then we've got our carrier relations team who daily looks after our carrier compliance to be part of the Houston group of people. So this reality just is compounding.
So you mentioned in that really long introduction you gave on yourself that, pardon? Yeah, that this is something that you don't think is going away, but you also believe that at some point in time, potentially people might walk from this. So let me ask you this: what do you think if the industry just said, we're not signing these contracts, the brokers aren't signing, the carriers aren't signing them, and push it back? I know it'll never happen, but theoretically, what do you think will happen? And I want you to answer that as well, Matt, after he's done, okay? Like, what if we just say, and I can say this because I don't chase customers, pound salt customers, we're not signing these anymore.
It all comes down to everybody wants to sue everybody, and this is protecting everybody from themselves. So, we sign contracts, and sometimes they're business decisions, and we've had some contracts down in the U.S. and the salesperson's coming back, yeah, but it's $20 million in business. Can we not sign it on a business decision? And the legal team's like, yeah, but you know what you're subject to here? Like, one false mistake by a dispatcher or an operations person giving a carrier somebody that's not required, the example you gave, that only have 2 commodities on their cargo liability, and now we're all on the hook. And I guess Houston, because Houston's part of the NYK group globally, they've seen this problem worldwide, so it seems like everybody wants to be covered.
What do you think, Matt? We just tell them all, pound salt.
Yeah, so, of course, the underwriters, and we had some...
I wasn't allowed to swear, so they told me that 'cause it's taped, so we'll just say pound salt.
One of the larger transportation underwriters out of the UK came over, and this is a bit more of a North American issue than it is a European or British issue, and came over and said, well, why don't you just tell your clients not to sign these contracts? I said, well, I probably won't have a lot of clients if I just told my clients not to sign these contracts. So what we try to do is educate. We take it back. We got that advantage. We can talk to the shippers. I can speak the shippers' language as to what they're doing. Yet the shippers don't have a lot of interest because, of course, there's somebody agreeing to do it. And it's that classic situation that the shippers want to pass down the liability. They're afraid of their exposures, particularly in the U.S., and somebody's going to sign it. And until there's an industry standard, I mean, you look at what the industries have done to set standards, it's all going out the window. I mean, the first thing you see in a U.S. contract is CARMAC is waived. So CARMAC was put in place specifically to avoid this sort of situation. Yet all of these contracts start out by saying, we're waiving CARMAC. Something's not quite right.
Can you just explain in layman's terms, CARMAC, so that everyone understands exactly what we're talking about here?
It's basically your limitation of liability. So CARMAC establishes limitation of liability. It establishes terms of trade for transportation. It's that standard agreement that everyone used to understand and know, and that the courts theoretically would interpret correctly, so you didn't have to go to court. You didn't need a lawyer. You understood what your limitation was.
So Mark, Luca mentioned that he's seeing a situation where customers, you actually make a deal with the customer, agree to the rates, and then the customer throws this contract in your face. Now, are you seeing that? And when you see that, what do you do? Because I know before this contract stuff was invented and I was moving freight, a lot of the rates were contingent on the liability and the value of the freight. So if the freight was worth $100, there was rate A. The freight was worth $1 million, there was rate B and maybe C. So, is it just this optics of trying to create a win-lose? But how do you deal with that? Has it happened to you, first of all? And how do you deal with it when you've already got a deal and now the terms of that deal have changed?
I'll give you an example of a very large transportation and brokerage company out of the States, booked an order with our dispatchers. My partner, who usually reviews the contracts, quickly was on holiday, so my dispatcher comes in and says, here's a contract. It's an order that's picking up out of North Carolina, blah, 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 blah. Can you sign it? And it's about 17 pages long, so I skimmed through it and changed about 6 or 7 items on it, initialed all of them, signed it, and sent it back. 15, 20 minutes later, I got the dispatcher from the other company on the phone and saying, are you going to sign this? I said, yeah, I did. They sent it to you, didn't you not get it? Yeah, but I need it signed free and clear. He didn't understand what he was asking us to sign. He was just told by his legal department or owners or whomever, get this signed. And so I just played dumb and kept going back, and I gave him some examples. I said, like, we are exposed for this, 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 and this. Would you sign that? I just need to have this signed, sir, and put in the file, and it needs to be clean. Are you going to sign it or not? I said, no. But you got to pick this freight up for me. I said, I'm not going to sign it the way you want it. And so we just went back and forth like this for a few minutes, and he was flabbergasted that I wasn't willing to sign this. So yeah, we push back, and some of these things are filled with all kinds. Well, you talked about the indemnification clause. Like, yeah, we lose freight over it.
But how do you deal with this at the point of the transaction? Like, how are you expected as a smaller carrier? And I'll ask David how they do this. So you're trying to move a load. I know you have vetted carriers, but there comes a point in every business where you've got to use somebody you haven't used before to satisfy a customer. So it's a Friday afternoon. You've got that carrier sitting in, Arkansas, and they throw this contract at you. How do you deal with it at that time?
I think it's the other way around sort of thing. The carrier doesn't throw us the contract, right? It's the broker that throws us the contract.
Right.
Right? So we're trying to move, and if that...
Yeah, no, so it's exactly the same, yeah.
So what we do, we have a policy at our business right now where we don't open up any new relationships with a load broker that we don't know. So we don't go on the load link or have somebody call us on a Friday and say, here, I got a freight to move, and away you go. It's just a rule in our business. So one of the steps that we've taken to avoid some of this is if we don't know you, we're not going to move some freight. So we have to develop that relationship first.
Right.
So that's one of the first things that we do.
What a unique concept.
Yeah.
I like it.
We don't do it. So, but we're probably one of the few carriers out there where most guys will, hey, I got a truck in Raleigh, North Carolina, load broker B's got 3 skids in Durham, North Carolina. I can put it on my truck, I can make an extra $500 and away I go. And that's all they're thinking, right? They're thinking the $500 that they can put on the truck, but they don't understand that $500 coming out of the U.S. could be a $50,000, $100,000, $500,000 exposure, right? So, and conversely, if we're giving a new carrier a piece of freight, we will vet them through other things, through their CVR, through their IFTA, through anything we sorry, the FMCSA, anything we can do, their safer stats. We'll still do a credit analysis on them before we give them the freight, right? We won't ask a carrier to, on the spot, sign a contract like that. But like Traffic Tech, we have a liability waiver with our own with our own insurance company that protects us if we have that extended liability with our client. So we've taken the onus in-house.
Right, good, very good.
Now, what we do is we work with our carriers back and forth relative to, okay, what can you accept, what can't you accept, and then take the extra stuff internally.
Very good. That's why they're a successful carrier. So Marcia, what interests me is this whole carrier-broker kind of fragile relationship. They love each other, they hate each other, they work together, they work against each other. Like, try to explain the freight brokerage carrier relationship to someone outside transportation. It's actually, in fact, I read an article before, it's mind-boggling. So, Marcia, is this dynamic hurting the relationships? Is it helping? What impact is it having on what I believe is already a very fragile existence that's more often about win-losing than win-winning and sustaining? Because the bottom line is that my sense now is brokers are winning, carriers are somewhat losing, but there's going to be a point where someone's got to haul the freight and make money. So I'm curious, Traffic Tech, the amount of freight you have, what's sort of your philosophy, your company's philosophy on that?
I think, the carrier-broker relationship has, I still think it's very much all about relationships. I still think that, you go back 10 and 15 years, we're in the same place where it's based off relationships. I don't think that any of us should be doing business in that crammed Friday at 5 trying to onboard someone last minute. And I don't think brokers should, have a policy where they're, trying to onboard someone brand new in that situation. I think that it is about building relationships. It's about, if the brokers have established lanes, having established carriers with pre-negotiated rates that are just, doing that same lane. And when it is an ad hoc or, spot shipment, that we're reaching out to the carriers we have relationships with.
Interesting, and I agree with that because that's the philosophy I had, but I don't know if that's the way that it operates today. It's interesting, I wrote a column recently on this, on carrier-broker relations, and I got hate mail from brokers saying, you're smoking something, because this is all about transactional, deal of the day, and we have some leaders up here, but I'm not sure if that's actually what's going on in the underbelly of our business, and it concerns me for the carriers, frankly.
I think there's both. I think that there's definitely, that ad hoc rush. I can tell you that our onboarding process is not quick and it's not easy. It does go through a series of things, and we do outsource the insurance certificates are being monitored by a third-party company. It's not the fastest thing to get done, and we have a lot of carriers in our database, but we really look at the ones that are active and that we've done a lot of business with in the past. I mean, everyone's afraid of, the identity theft and cargo theft, and it's really important to have those established relationships. So although there is still a lot of ad hoc, and I mean, it truly is the shipper's world right now. They can send an email to, all of us in this room, and we're all supposed to, jump and give the best price without thinking about what the commodity is, how much it's worth, is it running over the weekend, is it going to, if it's LTL, how many times is it going to change trucks? And I think that that's a problem of all of ours, brokers and carriers.
Mark wants to jump in here.
And I agree with Marcia on the relationship side. It's all about relationships, and we all have good relationships with load brokers and we have bad relationships with load brokers. But one thing Marcia mentioned, and we talk about this often, one of our values at Spring Creek is we know our freight and we move it profitably, but we've given a whole new dimension to knowing our freight. It's not just what's the value of the freight or what's the dimensions of the freight, what's the weight of the freight, what's the risk liability now of the freight. And our dispatchers are starting to pull their hair out. And what does it mean to know our freight? And then you're dealing with a load broker who has pre-established, I think you mentioned pre-established rates or something, and their dispatcher simply calls up and says, well, Spring Creek has this Durham, North Carolina, 3 skids, $500, whatever David was just talking about. This is our established rate, and this is right down the street from that customer, so it's $500. But what is the freight? And so you've got load brokers calling you and say, well, your rate's $500, but we still don't know what the freight is.
It's a skid.
What the exposure is.
It's a
Yeah,
skid.
it's a skid. A skid is a skid.
Skid.
Well, some skids are 8 feet long, some are 18 feet long, and some are worth $5 and some are worth $500,000. And so our dispatchers are frustrated because the load brokers, we keep telling them, know your freight, know your freight, know your freight. And the load brokers are going, it's a skid. I don't know what the hell it is.
Beauty.
Yeah.
Beauty.
I think that it kind of goes back to what Matt was saying before. I mean, we've been in this situation as well where, we told the carrier the commodity, they picked up, we've got the contract, we've got their insurance certificate, and don't realize that that could be one of their exclusions, and perhaps the person on the phone booking the load didn't know what the exclusions were. And I think it's something that we really need to explore going forward, is that if you're, onboarding with brokers, that you're providing your exclusions, so that when we are looking at a carrier selection, we are selecting the right carrier for the right load.
The challenge, of course, with that is it just takes time, and nobody has the time or patience to go through that process, and that really is what creates
To
risk.
put it in perspective, Traffic Tech and ourselves have been doing business for the past at least 14 years. And, we would get a contract we'd scratch it out, we'd sign it back, it would go into a file, get another one, we'd scratch it out, sign it back, it would go into a file. And then when you guys moved to the outside to have somebody monitor it, now the contract comes back, we do the scratch out. No, you can't scratch it out. So this has probably started 2 months ago, and 3 weeks ago, we were able to successfully sign the agreement together. So through our relationship, through our partnership, we were able to work through whatever it is was in the contract that was giving us, a little bit of grief, and what they needed to have to protect their client. But that's because we have that relationship, and we can have that and devote the time to go back and forth. Some of the smaller ones, some of the smaller carriers, some of the smaller brokers, just say, sign it. And that's where the real issue is coming from, for the guys, for a Marsh or for ourselves that are sitting at this table who, A, we want to have that contractual relationship to protect our business, but we don't want to put our business out in the open. And we're willing to say, sorry, I'm not moving that freight. And that's what all of the carriers have to do, right? Or all of the brokers have to do.
Well, that's a great lead in, because I'm getting the Barnum Bailey hook there from the back. So I'm going to ask Luca. Luca, we're in this industry together. Whether you're a broker or a carrier, we're in this industry together. What can we all do to protect ourselves, to try and mitigate the risk of these, these obligations that seem to be rolling downhill, and really, frankly, I believe, really putting a lot of people unknowingly at risk?
Are we going to talk about the customer side or the carrier broker side, or a little bit of both?
The customer, my philosophy is that we're in this together. What can brokers and carriers do to work together to mitigate the risk of these contracts, so that we can haul some freight, make some money, but not take on this liability that puts your family, you haul all these shipments, you're putting your family and years of hard work at risk. And to me, nothing's worth that.
Yeah, and so these contracts, it'd be nice to be standardized, but it's just between so many different customers and different provisions that people are throwing at stuff. The steps that, as a carrier and broker, we have steps at use in that, you have to be in business 6 months and sign our carrier agreement, because there's too many fly-by-nights. And, we can only protect ourselves so much, but then we got, situations like we had in the last month or so with identity theft, with the carriers, WSIB and all that stuff. So it's, to going forward, the only steps we can do is protect ourselves, is, get as much information we can. The relationships work. When we're doing process for rating, it'd be nice to have a contract before we rate something. We always find that we always get the carriage before the horse, and it's, we're getting the backlash afterwards, and the salespeople that are running around North America, even for USIN, we hear this, now all of a sudden there's 23 contracts there, nobody can move the freight, and that takes 2 months, and now you've missed out 2 months worth of freight. The contract's only good for a year, so now you're 10 months, you're only gonna have 10 months to move the freight. So these contracts should come out ahead of time, even before an RFP on that side. And the same thing with a carrier, when you're negotiating with them ahead of time, it's nice to have that contract in place.
Okay, Matt, I'm going to ask everyone to get a final comment on that, because we're really running out of time. So, Matt, just final comment on, for people in the room, things that you suggest they do to protect themselves.
It's, like everyone's been saying, it's about understanding your customer and understanding the freight. So if you have a contract or you're shipping something, understand it. And don't be afraid to go back to the shipper and talk to them about the risks that they're trying to transfer. And if you need to, escalate it up. If your shipper's got a risk management department, talk to them about why they're looking for this. And we're happy to help. And the broker, your insurance broker, should be happy to help you manage this risk.
Mark, brief, please. I know that's hard for you.
I was told that Karen wasn't going to talk.
I know that's very.
That's why
I know
I
it's
came
very
today.
hard
I
for
didn't
you.
believe it.
No F-bombs, though.
I'm curious, just looking online the other day too, seeing that there's a contract that's agreed to in the south of the border from the ATA and the TIA, who've gotten together and they kind of have this short form and long form contract, where both the carrier side and the brokerage side have agreed to some content of an agreement. I'd like to see if that's possible in Canada.
Well, to echo that, I think we were close to that, and I was speaking to David Bradley a little while ago, and I think we were close to that a number of years ago, and then it all of a sudden it just stopped, right? Because this is a secular thing. 10 years ago, you saw all those other contracts. Now you've got some other stuff going. But I think for us as an industry, I think this is kind of part of a symptom of us as an industry, really not educating ourselves as brokers or carriers as a whole on what our rights are. You know, we talk about Carmack, and people in the room have heard Carmack before, but really, what does it mean?
Type of Porsche, isn't it?
Yeah, exactly, right? But, so I think we have to take a greater responsibility of educating ourselves and pushing that back to why some of these rules have been put in place in the first place.
Marcia?
As Traffic Tech is a member of the TIA, and I agree, I think it would be great if we had some standardization similar to that in the US here in Canada, and I think, you know, we could model a lot of those contracts and almost have, you know, at least a guideline for what you should look for in a broker and what brokers should look for in a carrier.
Awesome. I know I'm getting the hairy eyeball from Rodney, but we're gonna ask questions. Yeah,
Yeah,
absolutely.
we got some time for questions.
Okay. Can I just say one thing? Please, pretty please.
Sure.
No joke. I think the answer is, as an industry, we have to learn to say no. I really believe that. You know, I see as an industry, we just cowtail to customers so often. It's mind-boggling. People are afraid to say no. And the one thing I learned in life and in business, you don't get what you want unless you're prepared to take your hockey net and go home. And that's to say no. And when you say no, you're in a position of negotiation. So that's my 2 cents, and I know it worked for us. So any questions for the panel? Please state your name, your company, and who you want to direct the question to. Louisa?
Oh, hi, I'm Louisa from Snowbird Transportation in Hamilton, and I guess my question is for Matt. Is there any merit in the carrier making their own general contract and carrier package to submit to load brokers? Not maybe regular direct shippers, because that's something a little bit different, but...
Yeah, actually, what I like about having that package to submit back is that you can now establish that you have a set of terms of trade that might be a little bit broader than industry standard. You can negotiate that with your insurer, and that way, if you've got an agreement where it's a bit broader, you can actually do a little bit more. It gives you more flexibility. It's not necessarily going to stand up every time. The shippers may be cascading down something a little bit higher than your standard package, but at least you've taken control of what you want to do and what you're comfortable with from a risk perspective. So, yeah, it's a good process to go through. It's not going to stand up every time, but it's worthwhile having.
Thanks, Louisa. Any other questions? In the back there?
Good day, sir. Excellent presentation, very informative. Pierre Barras from BioCircle. Just, I would like to hear some comments about the root cause of this. Do you think that from past experience, the end user, so the people who were buying the goods I was manufacturing and shipping to them, they were the one asking for all those clauses in the contracts, and all I was doing is really trying to make my end user happy, going through brokers or directly with my shipping partners. Do you think that these things come from the end user requesting all of those, passing along the liability so that they don't have to have any responsibility? Basically, they were asking for delivery to their site and they don't want to have to do anything with their liabilities. I'd like to have your comments to see if that would be maybe the root cause of all those requirements.
It does seem that nobody wants to take responsibility for anything anymore. So, you get a damaged load, it arrives at Costco's dock, and instead of taking the load, handling it, addressing it with their insurance, or then cascading it back from a recovery perspective, they just reject it. It's a laziness. The industry is expecting everything to be somebody else's responsibility. And this is what I think is creating that challenge. Walmart sets the terms, this is exactly the window you're going to deliver in. Costco says if there's any variation, we're not going to accept it. If the seal is broken, we're not even going to look at it. You know, it's a real change in responsibility and accountability that's just cascading through the industry. So yeah, I do think that the problem is that people are trying to appease these large customers, allowing more flexibility, then taking that load of slightly off-spec sausages and sticking them in a warehouse somewhere until they're completely destroyed. It's a bad practice. And from a claims perspective, you know, there's better ways of managing these situations, but people just don't feel that they need to. And it's high-volume retailers, don't have the space, don't have the interest, and they think that the carrier is going to accept the liability and pay them in full for the loss. So, yeah.
I've seen this from different perspectives, one being the shipper or the receiver or the carrier. Whoever's the biggest of the three is who's deciding what contract to use. So if the carrier is bigger than, if it's FedEx is bigger than Walmart, FedEx is determining the terms, right? And you're seeing whoever's got who's ever bigger. That's who's want to decide and that's where the fight begins. Well, I'm bigger than you, you're bigger than me. And that's where the contracts go. So it all depends on who's the biggest between the three.
You're saying size matters.
Size does matter. Absolutely.
That was way too easy, man. Way too easy.
Not to add on to the size matters, but I think even the non-contractual customers, the ones that you do not have a contract with, I think they're all self-insured until you want them to sign a waiver.
Yeah.
And I think as a whole, it's general ignorance throughout, whether you're a shipper, you're a consignee, you're a carrier, you're a broker. It's like, you just don't understand what is out there for you. And it's, you know, it's the Walmart, it's push the crap down as far as you can push it, right? And it's symbiotic in our industry, right?
Well, we have time for one more? One final question.
Hi, I'm Ed Duncan of Jet Express. Whatever happened to the $2 a pound rule?
Matt, that's yours, baby.
Anyhow, I've had customers.
Sorry, there's a $2 a pound rule? I've never heard of that.
Yes, there was a $2 a pound rule for years and years.
No, it's, you know what, that's the foundation, but it's been contracted out here, just like Carmack has been contracted out in the US. And this is the issue. You know, the whole responsibility to mitigate your loss. So the $2 a pound rule is great. It's a good rule of thumb. It's kind of what's there if there's no agreement in theory. But also mitigation of loss is a responsibility. It's embedded in the bill of lading requirements. But who mitigates their loss anymore? Who accepts $2 a pound? And when you talk to a shipper, so something's been damaged, and you talk to the shipper, okay, well, I'm going to give you $2 a pound. What do you mean you're giving me $2 a pound? Well, did you read the agreement? Well, I'm not going to ship with you anymore. So now it's a customer service issue. The $2 a pound, which is a great standard, doesn't apply because the shipper isn't going to accept it. And then it goes through the commercial side, and if it's a big shipper, well, you know, maybe we should waive that $2 a pound thing. Maybe we should go to $3, or maybe we should go to $5 a pound for them. And then that's when the contract kicks in and you're full liability.
My insurance broker instructed me for a few of my customers to let them know if it was over, say, $80,000 to mark the price of the bill of lading.
Yep.
And that's the actual part that's being insured then.
Fantastic thing to do. Basically, it's our recommendation as well. Point out to the customer that there is limitation. You know, make sure that your terms are clear to them and that they understand. And a lot of times with high-value goods, even if it's not high-value goods, have them sign off that, you know, our liability is limited, it's $2 a pound. Oh, and here is, if you want more, you can buy this additional shipper's interest insurance.
I was told by my insurance company that lots of cases, if it wasn't marked in the bill of lading, they were only going to pay that.
Yeah.
Then the fight starts, I'm sure.
Yeah. Hey,
Well,
Matt,
that's the misunderstanding.
we're going to have to take that offline, okay? Thank you for the question. Anyways, I want to thank the panelists. You were awesome. It was a pleasure working with you. I want to thank you for participating. I think the fact you're here shows a commitment to the industry, and have a great day. Thank you very much.
Mike, on behalf of OTA, thanks for moderating, and thanks again to our panelists.